So how to raise capital for primarily technology startup companies in the new normal. How to raise capital in the new normal. This would apply to a lot of companies, but of course, we're targeting in our audience primarily technology companies from around the globe. And let's say the first thing that we would like to remind everyone and every entrepreneur, I'm an entrepreneur myself. I've been all my life, done over 40 ventures, exited many of them successfully. Some of them, I still have them, and some didn't go well. But anytime we start a company, anytime we run a venture, we adventure out of our comfort zone. I mean, we as individuals tend to remain by default in a certain box that we would like to call comfort zone. As I say, beautiful place to be, but nothing ever happens inside our comfort zone. So it's when we start overstepping our boundaries and going into uncharted territory that something marvelous can happen. Anyway, I'd like to give you this quote here by Mark Twain. Maybe the first person you can think of in terms of distance from the financial industry, but I think it's a very beautiful quote, and it serves as well to remind every entrepreneur that the world per se doesn't owe us anything just because we decided to start a business. It's basically up to us to make it happen, and to make it happen so that customers or clients like to see it happening. So this is very important because it's not on doctor orders that we are in business. There's sometimes a misplaced sense of entitlement on the entrepreneur's part, because of course the realization that one has created a venture carries with itself also a certain sense of belonging and ownership, which exists legally and de facto, but nonetheless, as I say, this is not on doctor orders that we are running a company, and we can only run a company in as much we are capable of running it as a business that it is, and it deserves to be. And the minute that that company doesn't run as the business that it should be, we're out of business. Again, if we are afraid or if we're not risk taker, we should not be there in the first place. Now, let's take a look a moment at what we mean by venture capital, because we need to clear the vocabulary. Venture capital in this presentation will mean not only VC firms providing capital on a professional basis, but in general, any type of capital which is not from a banking origin. So anything that comes from the financial world that is alternative to the banking industry. And so it could be provided by VC firms, could be provided by private equity firms, by investment banking groups, by financial services firms, by family offices of all latitudes, both single family offices and multifamily offices, could be provided by high net worth individuals. It could be provided by corporations that are so-called strategic investors. And basically, in a nutshell, we will call all this capital venture capital. So venture capital comes not only from the VCs. I would say the main part that technology companies are trying to go for is a protocol called the VC community. We will see today here why this may not be necessarily the best option for a lot of technology companies out there, particularly as we are entering what we call the new normal in a post-COVID era, which we all hope will start soon. Some countries are out of lockdown. Some countries are still in lockdown. Some countries are still through the eye of the storm, and they have to go a long way before COVID is over. But nonetheless, we begin to see how the economy is shaping. And I would also add, before COVID anyway, we were already in the 21st century. And so things had to be done differently to the 20th century. Unfortunately, Many startups and small companies are still prisoners and at times victims of the old schemes of the last century. And it actually doesn't serve them very well when they go to look and raise for capital, because the world is changing, and it's changing at a dramatic pace. So I think the first message that I would like to bring to you entrepreneurs is please try to get your bearings on where the world is at and what is your geoposition, one could say, in reference to the world. And only after that you get into the venture, and when you have precisely defined the venture, you can go and raise the capital that you need. So the first question that the entrepreneurs like you would have is how many funding rounds am I supposed to have when I go raising? And there are all sorts of colors of the rainbows and types of salad when it comes to how many rounds you can have. I would say that I would identify, the pre-seed, the pre-launch capital, which definitely must come from the pocket of the founders, maybe from some families and friends. And then I would identify, seed, startup, seed phase, and then some other angel rounds, and arriving to the Series A. Now, this can be one or more rounds depending on the companies and depending on the geographies. But what we are seeing in the market is that Series A is really the first threshold that entrepreneurs and companies have to try to reach. And why I want to bring your attention to the Series A round is because there's a dynamic going on through the financial markets nowadays and the capital markets, by which, if we are looking at raising internationally, let's say raising below 15 or 20 million dollars or euro, it is very, very difficult. It's not impossible. And because fundraising is not an exact science, and it's an art, and investing in companies doesn't meet exact science requirements or postulates. But nonetheless, there are trends in the industry that are consolidated by now, and so we can tell with a degree of accuracy that if you're going with a Series A, which is below 15 or 20 million, particularly if you are not in the US and if you're not in the European Union, it might be very difficult to raise capital. Again, I'm not having the pretension to cover with this assumption all the possible cases in the universe of companies raising capital, but I would say that if we take a look at last year financial newspapers and see who has actually raised capital, we will see that the companies that have actually raised through Series A have all gone in a Series A format and amount, which is mostly, especially in the United States, larger, greater than $20 million. So this is a first reference signal that we want to be able to acknowledge from the industry. We say, especially in the technology space, that some of the technology companies are not really yet alert to this evidence. So I would like to stress it once again. Please, when you prepare your homeworks, try to see if your industrial plan can withstand the impact of receiving 15, 20 million. And we'll elaborate a little bit more during this masterclass presentation why it's necessary that you adopt this stance and this angle. Another question that you may have is, can the investors really help me at all? And how would they help me? Because sometimes investors are just limiting themselves by definition to provide their commodity, which is the capital, and not necessarily they will be involved in the business with you. But some investors are more hands-on than others, and they, by charter or preference or desire, they definitely engage, and they have an active say on the board of companies in which they acquire interest. But of course, these questions are spinning in your head. And again, another question that you may have for sure is, what is the true value of my company? And what if the company is worth more than I'm selling it at for? And the enterprise value. It's difficult to get an echo from a sounding board if you're alone. I always recommend that companies go to the market with accompanied by specialist investment bankers and advisors, unless they have them on board. But even if they have them on board, sometimes it's better to have an unbiased opinion, cold-blooded opinion that could be very useful when you discuss and negotiate with the investors. Because one thing is to have a qualified opinion from a financier who's sitting on your board, and another thing is to get the third-party qualified financial opinion on the value of your company. And of course, audits should always be presented whenever possible, independent audits on the valuations of the company, because they could support your case and give you more traction. Another question in the series that you see is, how much capital do I need? And obviously this goes back to what I was saying before. Let's say that the area, the territory on the line between the startup capital and the Series A, it's a sort of a minefield, no man's land. I mean, my suggestion is you should try to cross that area as quickly as possible, because that's where most of the entrepreneurs end up belly up and their ventures fail. So again, I want to address this point, because really in the last months, we're seeing that particularly under the coronavirus situation, many companies are adopting a very conservative, sometimes too much of a pessimistic stance. And I would like to actually bring a silver lining to the table. There's a lot of capital available, and capital has never really stopped being invested, even in the month of the COVID-19. Of course, there has been some logistics delay, primarily due to large investment banking groups and global banks having to readjust to smart working, telecommuting, and as a result, some deals have been delayed, and due diligences have not been possible in most cases where there was a physical necessity of a due diligence inspection and real field trip. But other than that, the market has been progressing, and in fact there have been even some very significant transactions occurring during this period. So this is a good signal for all entrepreneurs out there seeking capital, because it means that there's more than hope. There are actually the springs whence the water flows, and the savvy entrepreneur should understand where to direct herself or himself to quench the thirst of the company. But again, if coming back to my recommendation, please bear in mind that you should try to design and devise an industrial plan that allows you to cross the minefield from startup to Series A as quickly as possible. Which means you gotta be brave. You have to think bold. You have to think in the big picture. You have to look at the big picture, and you have to be capable of showing investors that you have understood the big picture of your company in the frame of reference of your industry sector. The chances are in your favor if you go and raise larger amounts of capital with a solid and substantiated industrial plan that justifies the amount of capital that you're looking for. So just for sake of clarity, I'm not implying or suggesting to anyone that you should artificially inflate your venture just to make it palatable for the investors, because anyway, the investors are not stupid and they will not buy into it. You will always ruin your reputation and your company. So the difficult exercise is really to think how to make it bigger so that they hire, the vast majority of the investors can be attracted to your venture because it meets their investment parameters. Because let's face it, a lot of investment funds, single family offices, and venture capital firms have such stringent parameters by which they cannot commit capital on very small transactions. And anyway, those small transactions never will bring your company to the level where it can begin to generate revenues, hence traction. So whatever money is sunk into these stages, investment phases, is completely at risk of being lost. So you want to make sure that whatever you raise, it takes you to where you get revenue generation. So I think it's a basic signal that you should be capable of detecting, but again, too many people go over the cliff because they haven't read the signal. So you want to remember that. And what if I fail? You see one of the questions there. Well, we go back to the previous slides. Maintain a positive attitude, because if you're in business, it means you want to be in business, and you have to be adopting the stance of the navigators and the pilots. The waves exist in the ocean. There's no ocean without waves. There could be a lull, but it lasts for maybe half a day, and then the waves start again. And again, even the wind is always there. Same goes for pilots. You're in the sky, there's always turbulence. It's very, very rare to have a day without encountering any types of turbulence, because we're living on a planet that's spinning very quickly, and the winds are there and they are part of the game. In terms of making your business plan broader and the scope of your venture broader, also beware about something else. You shouldn't make it any more complicated than it should be. Some companies have actually raised capital by writing their business plan on the back of a napkin. And while this is not the norm anymore, because obviously investors want to see a detailed range of analysis and predictions and forecasts and maybe opinions, still, I think it's a good sign that you are on a good venture if you're capable of describing your venture on the back of a napkin, and if you can deliver a presentation in less than 3 minutes on what your venture is all about. Don't forget, there are companies like FedEx that have raised capital with just a single page mini thriller. So that should be of guidance and of motivation for you. Now, what are we investors looking for when we look at companies that we want to invest in? Well, we're looking definitely at founders who can be visionary, who can be innovative, who possess strong leadership qualities and capabilities, who are strongly dedicated and committed to what they're doing. Somebody said in the past that they have to be ball and chain, hooked up to their company. I don't want to put it so bluntly, but definitely the founders have to have way more than just skin in the game. They have to be, completely committed to the venture for which they're raising capital. I think it's a matter of respect towards the investors before even anything else, and assessing price-earning ratios and other indexes that we normally use for our activities. I think it's a matter of respect towards the people that are coming to you, ready to give you, on a basis of just a risk sharing, a certain portion of their wealth, of the wealth that they administer on behalf of others, so that your dream can become true. So I think you want to make a point that you respect that act, that deed of transferring money from their pocket to your pocket, or to the pocket of your company, depending if you're selling share or if you're having a capital increase, or both. So also we want to see as investor ambitious and gregarious players, people that are capable of building up teams and running those teams. And so cooperation, teamwork, and again, people that can be getting out of the bed on their own without being prodded out of the bed, and they can find their own motivation in the morning when they get up and go pursue their dream, and they don't lose their north. They always have their compass with them. So business orientation is also very important, because don't forget that not all investors are active investors. Some are just, passive, and so you will have to do all the work. So please keep in mind these factors. Now, the typical negative answers that you founders get on the market when you begin your impromptu or formalized roadshow are the following, and some derivation of the following ones that we see here. Most of the people would tell you, this is very interesting, but come back later when you have traction, when you have shown that you can raise capital from someone else, or any variation of the basic flavors that I'm putting here. Again, this should not deter you from continuing and insisting. I can tell you an experience, at least a couple of times in my life, I was raising capital on my ventures, and those ventures were pretty crazy. Actually, in one, I was an advisor, and in the second, I was a principal. But they were far-fetched ventures, and I kept receiving a lot of no's. In fact, I kept receiving not only the no's, I kept receiving also feedback that, no, what you're trying to accomplish is virtually impossible. But obviously, that was not the case. It was not only legitimate, but very possible. It was just a matter to find the right interlocutors. And I've insisted, and I found in both cases, in the first where I was an advisor, and later when I was a principal, the solution to my equation. So don't worry, because you have to be just as persistent as I and any other entrepreneur has been. And many of the investors that will have a dialogue with you are also entrepreneurs in their own right. So they may have gone through the same learning curve that I've had and that I've gone through, and you will go through. So as I say, don't lose your heart, especially don't lose your focus. Remain, with your eyes on the crosshair, and keep the target in the crosshair, so that you can then, blow it away when the time comes. It's very, very important. And also, investors want to deal with founders who are positive, optimistic, and not with people who are depressed, because it doesn't bode well to entrust your capital, especially if a capital that was even yours is third-party capital, in the hands of people that don't feel very comfortable, running the vehicle that they have to run. So be positive and maintain a clear spirit. Now, of course, this is the, I would say, quintessential image of the sharks investors, and but again, like sharks are not really attacking most of the humans that are at sea. I think also most of the investors are not animated by hostility or aggressivity. Of course, every investor is trying to make ends meet and to service his or her own bottom line. But that doesn't mean that should be at the detriment of their counterparts. So it's a matter of finding a balance. And again, going back to the original slides that I presented at the beginning of the masterclass, it's not on doctor's orders that you are being an entrepreneur. So if you don't feel comfortable, pull over, unbuckle, and and get out of your vehicle, and the world will take notice. But again, you should not be utterly concerned of the fact that investors sometimes are defined sharks. In fact, there are just a limited number of players in the market who are engaged in hostile takeovers. Most don't. So, of course, investors, as I say, will have to service their own interests. So you have to be wary of what the investors think. So documentation and research is something that you should keep doing throughout your career, not only in the phase in a pre-series A or in a seed or pre-IPO. You have to do it all over, even when your company is mature, because as we see, sometimes there is a misalignment of perspective. VCs, and not only the VC firms, investors or risk capital and founders sit on the same board, but they have different opinions about things that should happen. You founders are concerned with valuation, with the burn rate, the runway that you have ahead, and the exit strategy for you and your family or your initial co-founders. The venture capitalists at large, as a broad category, they're more interested in avoiding personality conflicts and also their own exit strategy or divestment period if they are investment funds, and what management changes they have to bring on to ensure that the company hit the targets that the covenant and the agreements implicitly and explicitly have defined. So your job is one to try to realign as much as possible those potential divergences and try to make sure that you're all on the same page, because don't forget that you have skin in the game. Of course, you can get trusted advisors on your side of the table, and this trusted advisor could be venture capitalist investors themselves. So it will be an equal battlefield. Now, there's a Chinese proverb that I like very much that says that the best time to plant a tree was 20 years ago, and the second best time is now. What it means is, of course, there are a lot of things that you could have done better in the past, or if you had started earlier. But again, this is no reason for weeping and complaining and not taking action and do what you need to do now, because there is still time to do a lot, and your venture is in its infancy probably, so it can still grow healthy and go through the eye of the needle and why not maybe become even a unicorn. And again, don't forget, if it was so easy being in business, everybody would be in business, and not all of us are in business. So another say mantra that I would like to repeat to all of you, just because, especially in moments of crisis like in this COVID situation, there's a certain paranoia and pessimism, also because of the negativity that is spread around by the media. So I would like to remind once again to all of you that you should not be afraid of what could go wrong, and you have to be concentrating on what you can do to make sure that things go right. And maintaining this positive attitude will reflect onto your labor force, onto your employees, onto your sales force, and ultimately will be transferred to suppliers, stakeholders, and the investors coming to your office virtually or digitally, as we're doing now, or physically. They will be capable of discriminating that there's something good going on. And this is the proactive spirit and drive that you have to infuse in the venture. And those emotional or psychological components are just as important as the technological, economical, and strategic organizational component that you have to embed in your venture. So don't forget them. Now, though you can see the slide, now when the investors come on board, sometimes there's a change in the leadership. They bring new people with them, new C-level officers, and why would they replace the drivers or the skippers at the helm? Well, I'm giving you here some of the recent statistics. It's 83, and those were formulas, questionnaires made with multiple answers. So the investors were allowed to give more than one answer for their reasons to change healthman. Well, 83% recently responded that they wanted to recruit people with more sales and marketing experience. This is an important indication for you founders, because if you can attract in your lineup, in your management team, or on your board, people with this type of background, sales and marketing, before you meet the investors, obviously the investors will take notice that you have covered that important base, and will as I say, in case they close with you, they will tag it with a premium value because already you've done something that they have to do anyway. So if you save some of their work for the future, of course, the benefit can go directly into your pocket or in the pocket of the company. And 63% of the investors say for operational leadership reasons. And this is a little bit trickier because it has to do more with the founders. There is evidently the perception on the investors' side when they have had repeated meetings with the founders, or even after closing and they are working together as partners, that the founder, to use a military paraphrase, the founder may be a good colonel, but it cannot be a general. And of course, to run a venture, you need a general. So in this situation, much as the investors do not like to do that because it's never nice. I don't think there's anybody fancying really firing people or anyway demoting people. But for the sake of protecting the venture and the capital that has been invested, which by the way protects also your capital, they have to operate certain changes in the management team. And sometimes they have to replace you with people that they deem to be more capable to transition the company in the phase where the company is at this present state. Now, in terms of success factors for startups to raise capital, we need to remember what are the building blocks of a company. And I try to make it very simple here on this slide. Is that I don't like slides that are filled with too much information that it's clogging our mind and it gets us very dizzy and tired. So I think the biggest initial block is what I call the raw material, which is basically all your IPR, intellectual property rights, intangibles, whatever you have, if it's inventions, is it research findings, this is new technology, beta testing of products that you have, and licenses and rights and grants and permissions that you may have obtained already as a result of your entrepreneurial initiative and commitment to this date. The second building block is the business model. And this is where a lot of, it's the banana skin where a lot of entrepreneurs slip, because the urge of moving to market with the feeling that the runway is getting shorter and shorter sometimes produces certain negative results. That the business model is not as refined as it should be. And as a result, when you finally sit in front of the investors, you burn your chance. And it's very difficult to get a second chance with that particular group of investors or in single investors. So you will have to waste your time and invest more capital to go and address and present and pitch other investors. So you see where I'm going with this. You have to try to maximize your effort and be very, very cost effective. If you have to spend a week or a month more on the drawing board, so be it. I would definitely recommend you do that, because apparently you're not gonna having any income, and maybe you're also having troubles meeting expenses. But that extra amount that you spent on the drawing board will pay out handsomely by the time that you sit with the investors, because they will not see the pitfalls that they would have otherwise noticed in your business model. So please be sure and make sure that your business model, and to paraphrase a quote, is seaworthy, and it can float. Now, market. Try to remember that you're not a business administration specialist, that you have to be an entrepreneur and manager of a growing company. So concentrate on the tasks that have to remain means to an end and not destinations on their own, because the minute you begin to mistake the means to an end with the actual end, you are going to put yourself in a difficult situation, in a quandary from which you might reemerge, but at great cost, and sometimes at great sacrifice of interest control in your company. So you can see that how you address the market will determine the economic failure or the economic success of your venture. So you have to be quite responsive to the feedback that the market gives every day, and both in terms of economic data, in terms of geopolitical data, in terms of industry regulations and legislations, trade barriers, trade tariffs, and so forth, on and on. I could continue. Anyway, this is broadly defined as market. You have to be an expert on what's going on. If you cannot do it alone, well, you have to have someone with you on board that is capable of reading and decoding these signals. Now, for example, these are 4 success factors that a few investors consider vital when they are committing investments. So I'm trying to give you a little bit of an example of what the other side of the barricade, the investors, are thinking when they sit at the table with you. You know, they want to see a powerful team and a very coherent and strategy, and that this should be an immediate result, that it should be immediately obtainable. You know, the coherent connection among the several team members, and the backbone of the strategy should be, you know, immediately visible and perceivable by every investor. And of course, you know, the capability on the founder's side to bet the farm on the right products, so that, you know, you are really putting the finger in the wound where it hurts for the market. So you are delivering a service that can heal that wound and cater to that demand. It's another thing that especially strategic investors like multinationals like to see in a technology company. Choosing the right financing strategy, I cannot even repeat myself enough here. You really have to, going back to what I was saying about the Series A amount, you need to make sure that you tell your whole story and you tell it right. Investors are like the publisher of your book, and you're writing a book. You cannot expect that you can sell the book in increments that we would call chapters. No publisher would buy any book on the basis of having seen just 1 chapter or 2, unless you are a published author and a published successful author that has sold millions of copies. Otherwise, you will have to prove that you can write the whole book. And what I'm saying by this is that now you see how these 2 elements go back together. The fact that you have to go as fast as possible to the Series A, because many entrepreneurs are really afraid of confronting themselves with the mirror. They are afraid that the full-blown venture may not be that unicorn that they were hoping for. And as a result, they tend to push the envelope and you know, kick the bucket further away from them, in the hope that something happens later that could correct this state of affair. Well, guess what? It's never going to be corrected if you don't intervene. You have to really write the whole book and have the nerve, the courage to look at yourself in the mirror and see if the venture that you're presenting is a good venture or it isn't. But if it is, and chances are that if you begin to think in terms of the big picture, you will be able to determine a lot of aspects that you previously had ignored or chose to delay in terms of analysis. If you really take a look at the big picture and you create a full plot of the book, you will find pleasant surprises, because all of a sudden the publishers will materialize and begin to send you offers to publish their book, which means to publish your book, which means offers to get into your company. So you see where I'm going with it. Again, I think the right financing strategy is very, very important. I, for one, would never invest in companies that don't show me that with the money that I put in are capable of generating revenues, because my money would be probably lost, even with the best of intentions on the founder side. I'm not saying that, you know, this is, you know, not considering any misappropriation or fraud or other types of illicit behaviors and crimes. No, I'm just talking even a pretty good entrepreneurs that, you know, would just, let's say, utilize their runway in an appropriate manner, and only to discover that then they have to go knock on doors again, even at the same investors that they've already gone initially, or at different investors. Not a good idea. And again, anytime you knock, you will dilute your own percentage in the company, if ever you raise the money. So, and you know, other important point after the financing strategy is really communicate your strategy and products very well. So you have to have an efficient media arm, either internal or external, that can take care of, you know, delivering the information to your audience, both via social or advertising or other personal angles as you see fit, but it has to be done in a professional manner. Now, alternatives. You should build redundancies in your company. You have to be adaptable and flexible so that the company can have maybe a side business or a backup business in case something goes sour. What can happen in the market? Well, things like COVID-19, earthquakes. It could be a drought, wildfires. You could have some earthquakes, nuclear disasters. There's some of the global financial crisis, let alone wars. But, you know, a lot of things can happen on a daily basis that would have a minimal impact on the life of larger corporations, but would have definitely tremendous impact on the life of your own company, because don't forget, your company is in its infancy, so it cannot take the blows that an adult company would take or a mature company would take. So try to begin to build in the redundancies that you need to offer yourself and your investors a diversification, because you will be rewarded. Savvy investors will notice what you're doing, and again, tend to award capital to companies that are building redundancies versus companies that are not. Again, I mean, our greatest glory, as Confucius said, is not in the fact that we never fall, but it's in the fact that we can rise again every time. And, you know, I think the life of every entrepreneur is a story of trial and error, and no one is immune. It's important to get up one more time. Now, going back to what we said, please try to reach as quickly as possible a coherent business plan, an industrial plan, which means you have to understand your market very well, whereby you can be able to raise on a Series A round at least 20 million, because that would put you under the spotlights of thousands of qualified, accredited investors around the world. Below that threshold, you will have to be very lucky, because some of the bigger fish sometimes dive in deeper to take a look at something, but in general, they don't, we don't. So you have to be content with the very diversified universe of, let's say, informal investors that exist in the space, in the minefield between 0 and 20 million. And you could find really people coming from all walks of life, sometimes not even very compatible with your objectives. So I would recommend a lot of caution if you have to you know, tread in the swamps, and try to clear the swamps and the minefield as quickly as possible, and try to reach dry land. Also, be aware of your runway, prepare for technological obsolescence, and especially, I would say, try to see if you can have a competitive edge before you enter the market. So what it is really that your venture wants to address, not only the unique selling proposition, but really why is your venture necessary on the market? Because don't forget, if you do it with your own capital, you could do whatever you want. But if you do it with capital of others, they will question why your venture, why not another one? So you have to be prepared to deliver, I would say, cogent and coherent answers to this very important question. So don't blame others. Don't blame even yourself if you're not yet there. You just don't blame anyone. Just do what you need to do. Now, this is an example of a business plan that has raised capital. And you can see already from the contents and the summary how the chapters are well organized. That means that the founders' minds were well organized and they had a clear strategic plan in mind. And because how you think, you write, and how you write, you speak. So don't forget that this is something that it's important to remember. Be clear in your communications to the investors. I still find very excruciating and odd with the sources that we have available even through the net nowadays, that most executive summaries that are sent to us still do not exactly express what the company needs. So in a way, the investors is forced to read maybe through 300 pages of business plan and paraphernalia documents, and we don't have the time to do that. So I urge you once again, please, your executive summary must contain everything inside. Who you are, what you're gonna do, how much money you need, how much money you invested, possibly when do you expect to pay back the investors, or what's the exit that you see ahead. An investment summary, an executive summary worth its name should contain this information, and should not inflict on the investors to have to go through presentation decks and offering memoranda or business plans. I don't think it's fair, and ultimately it will not get you where you want to go. Picasso used to say, that he was always experimenting with something new, and that's why actually you become better and better, and Picasso became who he was. So you have to remember that there's no shortcutting. You got to go through the learning curve, and you got to do a lot of mistakes and error before you reach your intended objectives. So again, if it were so simple, everybody would be in it. How badly do you want it? How badly do you want to have the success of your venture? So it's very simple. Think about it. Well, this is another a real life feedback from the other side of the table, the acquisition criteria of a large investor. And what I want to show you by this is that this information is very available on the market. So you should do your own research and try to assess what's going on in the prospective investor's mind, because this will help you to determine whether or not those prospective investors are the actual prospective investors that you need. And if so, you can try to prepare answering some of these very likely questions that they may have when they come to meet you after being invited by you or by your advisors. So keep it in mind that resources are available on the market, and if you go with trusted advisors to the market, they will give you even more access to intelligence and competitive analysis. Also, don't forget that the venture has to be really embodying what you feel about life. I think about Mohammed Yunus, the Bangladesh banker that has been awarded the Nobel Prize. He was feeling resentful that poor people in his country, particularly women, could not access debt financing. So he made a little experiment, giving really a few dollars to a few dozens of women, very poor women, and he saw that all these women repaid their loans in timely fashion without any default. From that, he went on to establishing the basis for what later has become known as microcredit or microfinancing. And you see here we have an entrepreneur who wanted to do something special in life and has found his purpose and his trail to go where he needed to go. And of course, he didn't do it because he was expecting to receive one day, if ever, a Nobel Prize. He did it just because he felt compatible with that vision of the world. So if you want to be successful, you have to be thinking like Yunus. You have to do something that you want to do and you like to do and you know how to do. Always in your backpack, you want to pack this gear. Be aware of new trends in your industry, because if you don't look on the rear view mirror, your competition will catch up on you and pass you very quickly. So you have to be able to recognize new developments in technology, in the competition and market environment. You have to be able to develop new concept in would say, easily understandable manners, because you have to transfer this to your team, and then you have to transfer this to the market. And then you have to go through the exercise of executing all of these things. So it requires a lot of stamina on your part and on the team members that you choose. So try to validate if any and all of your team members have the same degree of staying power that you have to get you where you need to arrive, which is at least the next funding round. So, you know, this is the creek of the river that you have to cross. And as I say, if you're doing what you like, you will steer enthusiasm, curiosity, humor even, and definitely optimism. And be prepared to troubleshoot, because companies are aggregated ensemble of issues, and they tend to occur on a daily basis, those issues. So it's never a sunny day when you run a company. But again, like Steve Jobs said, is people who are crazy enough to think that they can change the world, they in fact might change the world. So without further ado, with this, I thank you all for having listened to this La Token Masterclass presentation. I'm Giampaolo Parigi. You can reach me on LinkedIn, on my website, giampaoloparigi.com, or via La Token. And back to you, Nadia. Thank you.